Good morning, everyone. So I'll run through the slides, and we'll take maybe questions at the end rather than through it, just to help the flow. Yeah, Ronan mentioned the fact that this idea of full employment, and I think that's something we kind of got a bit used to it, but it's not that common, historically. So I think we all know that the last couple of years have been very kind of unique in many ways. But probably what we all forget is that if you look at the 10 years to 2020, it was unique in another way, which is that there was not, for the first time ever, there was a decade in America with no recession. There's an institution called the National Bureau of Economic Research in the States, which formally dates every business cycle. And they go back to the end of the Civil War in 1865. Every decade in America, there has been a recession. So the decade to 2020 was the first decade that wasn't the case. And of course, we did then get a recession in 2020 in the first couple of months of the year because of the pandemic. But as a result of that, really, we had a very long period of continuous expansion. And as a result, we ended up in most countries with very low unemployment, around full employment. And of course, we had the pandemic, but because of the fiscal response that most governments did, it kept everything going, and as we'll see also, it actually helped to even give further impetus to what was a long housing market boom. So just looking at these different countries, you can see that virtually everywhere unemployment's at record lows. In our case, it's 4.3%, so we're I think anyone in business would probably say hard to get workers. Labor is scarce. It was briefly below 4% in 22 years ago. But the euro area, 6.6% is a record low. United Kingdom, 50-year low. United States ticked up slightly lately, but again, it has been lower than that back in the 50s and 60s, but you have to go back a long way. So in that sense, the economies have performed extremely well. But of course, something happened, as you can see from this chart, particularly from the latter part of 2021. And that is that we had this long decade where we had virtually no inflation globally. And central banks actually spent a lot of time trying to tell us that wasn't a good thing, particularly our own ECB, which I think is a kind of a hard sell to say to people, 1.5% inflation isn't good, but 2% inflation is better. So they spend a long time trying to get inflation up, and you might say they've been spectacularly successful. So this chart here shows you, just put on for the euro area, Ireland, US, UK. And you can see that obviously they're all trending the same way. So that suggests that there's something, there's similar factors driving everything. And of course, initially, particularly, that factor was energy. And to some degree, of course, with the reopening after the pandemic, there was a lot of supply constraints, both domestically, but also globally, and particularly, Asia didn't really open up fully, so there was a lot of problems with in terms of on the chip side, had a big impact on things like cars, the supply of new cars, which if you think about new car prices in Ireland, for example, they're up 12%, which is kind of unusual. And also huge problems in terms of shipping, containers and so forth, like that. So all of that pushed up prices. But also, it's interesting if you look at those charts, in fact, although you mightn't think it the way the market reacted, but for the last couple of months, US inflation's actually fallen. Now, last month, it didn't fall as much as the market thought, and the core rates went up. But you could argue, and I think there is a case to be made, that in some cases inflation is probably around the peak. One of the big questions, though, is, and this goes back to really what you should do about inflation, and that is what's causing it, and is it demand or is it supply? Because if you think about, if you remember some simple economic idea of a demand and supply curve, if there's a supply shock, it raises the cost of producing something. It shifts the supply curve leftward, pushes up prices, but also reduces output. So if it's a supply shock, that's a bit different from if it's driven by excess demand, credit growth, a lot of borrowing, and so forth. So it's interesting, I think, to think what do central banks make of it? And I've put two statements from the recent ECB meeting, and I would be quite concerned about the ECB more than I would about the Fed, because I think it's very difficult to understand what they're doing now, which I'll come back to. Because if you look at what they're saying, why have we got inflation in the Eurozone? Soaring energy and food prices, okay? So will interest rates affect that? That's obviously a surprise. You can't influence the supply of food or energy with interest rates. Demand pressures in some sectors owing to the reopening of the economy. And supply bottlenecks, right? And then in response to a question, Rick Lagarde said, inflation in the United States is largely driven by demand. In the euro area, it's largely driven by supply. So if you read any stuff the ECB, they still largely think it's a supply problem. And in fact, Philip Lane, he tends to emphasize that quite a lot. In the States, I think there's a kind of, there are various models that people have put forward trying to break down inflation into demand and supply. And in the States, it's a bit more mixed. And there's certainly, the Fed argues demand pressures there, but also still the same kind of supply pressures. Particularly, of course, still from energy. And of course, in Europe, the energy issue is more to do with natural gas, as we'll see. Now, just to put a little bit of meat on that in terms of our own inflation, because I think it brings out an interesting point, and that is, initially inflation was largely driven by energy. And in this case, if you look at January 2022, this is the Irish inflation figure. And what the chart shows is the contribution, which simply says, okay, so if food is 10% and it goes up by 10%, that would add 1% to your overall inflation rate. So the contribution is made up of how much the weight of the component in the consumer price index and what's happening to it. Because, sometimes there's a lot of media attention given to certain things which have gone up quite a lot, but they have a tiny weight, so they're not going to add a lot to the overall inflation. But if you look at, it's like Twin Towers, isn't it? So there's two things that are driving inflation at that point in time in January. So inflation at the time was about 5.5%. And you can see that two things are adding 2% each. So that's 4% of the overall 5%, right? So virtually all of the inflation was driven by two things. One is housing. So what that includes is, apart from rents, which is rising quite strongly, the second one is utilities. So that's picking up the starting to be significant rises in utility prices, gas, electricity, and so on. And then on the other one is transport. So transport's obviously picking up largely, well, partly the rise in car prices, but also mainly the cost of driving the car, fuel costs, and also things like airfares and stuff like that. So you can see not much else is adding to inflation. If you go over to August, inflation was 8.7%. And you can see that you're still getting a massive contribution from housing. Utilities still the biggest driver. Transport is roughly what it was back in January, but as a percentage of the overall inflation rate, it's diminishing. And then food is now adding 1% to the total. And look over here, hotels adding over 1%. So it's, as things are reopening, and we're all, if you think about the pandemic, we could buy goods, but we couldn't really buy a lot of services, particularly personal services. So you know, eating out, entertainment, holidays, so all that kind of stuff. So as they opened up, this led to significant price increases in things like restaurants and hotels. So inflation is broadening out without any question. So I often think one of the interesting things about markets, if you look back, is what causes the problem? Is it inflation per se, or is it interest rates? Is it the policy response? And historically, the argument usually is the policy response tends to, in the end, do the damage, because the problem with interest rates is it's a very blunt instrument to affect anything. And the standard idea is if you raise interest rates today, it'll not really affect the economy for some time, for a year, even 18 months. So that time lag makes it very difficult for central banks to decide to know when to stop. And I think it's pretty clear that back a year ago, and even into early 2022, central banks had the idea inflation is all supply driven. And so they had this term transitory. If you think about it, the UK raised interest rates last December, and they're the first of the main banks we look at to do that. The Fed didn't raise interest rates till March, and the ECB didn't raise interest rates, of course, till just a couple of months ago. So they were all of the view that things would settle back down again. And of course, they've changed their minds, and they've now decided to go hell for leather about raising interest rates. And that, I think, raises the risk of policy errors. So what's priced in? So this is very volatile, and one of the problems is you can get a good handle that there is a futures market for what's called the Fed funds in the States, which is what the central bank targets. But the other ones, you'll get slightly different. There are money market rates, which aren't, strictly speaking, the rates for the central banks. So these are forward rates, which I did yesterday, and they've got very volatile. And they actually spiked a lot in the last couple of weeks, because there seems, after that Jackson Hole meeting, central banks seem to have got much more hawkish. So you see, the United States interest rates were virtually zero, so they raised them already by 2.25%. So here's the Fed has a range to 225 to 250. So end-year pricing is now jumped up to 4%. That even a month ago was like 3%. And you can see the market thinks the Fed will be peaking around the spring, maybe up to certainly 425. Actually, then the market is pricing in the Fed will be easing again as we go through 2023. So essentially, particularly the United States is pricing in a recession. But I would say it's like a Goldilocks recession. So the term Goldilocks was used for the economy back in the noughties, in the teens, which was that it's not too hot that the Fed have to raise rates, but it's not too cold to stop employment rising and unemployment falling. So I think the market was kind of anticipating, there's a good rally in equity markets in August because the market was, in market jargon, they were talking about a Fed pivot. That was the Fed would pivot from inflation to growth. Because the difference between the Fed and these other two is that they have two goals: low inflation or stable prices and full employment. An unusual thing. So the market, I think, has got a bit more nervous about the fact that inflation hasn't fallen as quickly as they thought it would, and consequently they've priced in higher rates. UK started raising rates in December, and they've gone up 165 basis points. They were 0.1%. So again, quite sharp rises, and then peaking around 4.5%. I would say that this is a snapshot in time. This forward rates are very poor predictors historically what actually happens, and they change every week. So if we got a weak employment number in the States, in a couple of weeks, that would fall very sharply again. And then our own euro area. There's one just a more technical thing, is that because there's so much liquidity in the Eurozone, what determines the interest rate in the market is the deposit rate. So the deposit rate is currently 0.75%. So if you look at, say, 1 month money in the markets, it's actually below 0.75%. For people with a tracker rate in Ireland, this is the more important rate, the refi rate, which is about 50 basis points higher. So again, the market is pricing in, by the end of the year, we'll get another 1% from the ECB, and then much further increases as we move into 2023. I should also say, by the way, that not everybody is tightening policy. Japan hasn't raised interest rates. It's still targeting even its 10-year bond yield to be just 0.1%. And China is now kind of starting to ease because it's concerned about its own economy. And that obviously, if you just had perfect knowledge of all of that, you would think, which currency is going to do best in the past, if you were looking back at 18 months ago, which currency is going to be best? And you'd say, well, probably the US dollar. And of course, that is exactly what has happened. So a big factor in the dollar strength is, this more aggressive Fed, and the fact that, it's a huge move, for example, against Japan, because, if you compare the two central banks. The other thing, of course, is that when interest rates were low or even negative, central banks were trying to stimulate inflation. Seems irony now, of course, but and what they were doing was that they were printing money to buy government bonds, QE. So now we have a question about the opposite, which is QT, quantitative tightening. So if you're going to raise interest rates, it don't make much sense if you're going to buy more bonds, with one exception, which is the ECB, which we'll come back to. So quantitative tightening, so what central banks have started to do now is to start to shrink their balance sheet. So they're injecting huge amounts of liquidity into the system. They're now tightening policy, so it also makes sense that they should start to reduce some of their balance sheet, some of their additional liquidity. So the United States are doing that by, they have they have a huge amount of bonds. Some of those mature every week, every month. So what do you do with the maturing bonds? So in the past, they've just taken that, if 10 billion matures this week, you buy 10 billion again. So you're keeping your balance sheet the same. So the Fed announced earlier in the year they were going to start reducing their balance sheet. So in other words, if 10 billion is maturing, you invest maybe 5 billion back into the market. So gradually your balance sheet falls. As yet, they're not selling bonds back into the market. The United Kingdom is doing the same, except they did announce a few months ago that they were going to start selling bonds. Some of the bonds, not all of it one go, but they gradually start to sell some of the bonds, which conceptually, obviously, would put a lot of pressure on longer-term interest rates. Now, whether they're going to do that now that the UK is going to announce, the new Prime Minister, Liz Truss, is going to announce, it would seem, massive new borrowing. So whether they're going to do that is kind of, I think, problematical. And in fact, and so nearer home, the euro area, it's quite remarkable in a way that the ECB was buying bonds right until the start of July. So they're injecting money into the system. So then obviously they changed tack dramatically, as we'll see. And so what they have two things going. One is called the PEP, which was the Pandemic Emergency Purchase Program, which was specifically, supposedly, to counter the effects of the pandemic on the economy. But what they're doing with that is that they're now left with this problem that as you start raising interest rates in each country don't rise at the same rate. And so longer term rates, for example, in Italy or Greece, are now significantly higher than a lot of other places. So Italian bond yields, 10-year bond yields, yesterday were 4.1%. So that's going to be problematical for Italy, particularly as they have an election coming up now, so a change of government. So what they're doing is they're taking the PEP reinvestments, or the maturing bonds, but they're structuring them back into buying more Italian bonds. So for example, if 10 billion of Irish bonds or German bonds mature this week, they're not taking the 10 billion and reinvesting it back in Ireland or Germany. They're taking the 10 billion and buying more Italian bonds. So that wasn't supposed to be what the PEP was supposed to be doing, but they're now doing that. And it's obviously going to be a big challenge for the ECB. And the other thing that they announced is some kind of new instrument called the Transmission Protection Instrument. So they said, if necessary, we will buy Italian bonds with this new instrument, but it's a bit unclear. It's not been legally set up, and I wonder if it's running to legal or political challenge, maybe more from Germany. But also they're going to, all their old QE that they have before the PEP, they're still reinvesting that, and they said they'll reinvest it for an extended period. So the difference between the two really is that the ECB, although they're raising rates aggressively now, they're still keeping their balance sheet very high. And I think the problem for all the central banks, and I'm just highlighting it from the ECB, is that the inflation acceleration that we saw was just took them all very much by surprise. It took everyone by surprise, in fairness. And I suppose nobody would have predicted that you would have had the Russian invasion of Ukraine and the impact on natural gas prices and so on. So here is ECB inflation forecast. This is March. This is June. They do them every 3 months. So in March, the ECB thought inflation this year would average 5%. In June, this is the average for the year. In June, they thought it would be 6.8%. And the latest one, last week or a week before, is going to average 8.1%. So they've consistently underestimated inflation. For 2023, if you think about what they thought in March they thought, yes, there's going to be a spike in inflation, but in 2023, inflation is going to average 2%. It's going to fall right back to our target, so we don't need to do anything. In fact, in 2024, it's going to be slightly below our target. That was their view, and obviously this changed. And now they think it's going to be above their target. But what I think is quite interesting is it's very clear if you look at what the ECB are saying and read the minutes of it, they've lost all confidence in their own forecasts. And I don't want to go into it in any detail, but the models that everybody uses are called general equilibrium models. And if you're thinking about just think that term, general equilibrium, it means that everything goes back to some kind of equilibrium. And the equilibrium tended to be that inflation will always go back to 2%. So whatever you do, there's a shock, and inflation always goes back to 2%. So in other words, in many ways, the models are useless, but they use them. I think the ECB has now got fed up, or at least the Executive Council, particularly the German ones, have got fed up with that, all those errors always. So, as I said earlier, I think if you compare the two central banks, the Fed have got this mandate that if the economy deteriorates more rapidly than they thought, they may well adjust their interest rates in a softer way, and particularly if inflation does start to fall. I think the ECB is a bit different, and I'd be more concerned about that, because I think it's hard to me, even just a year ago, they came out with this brand new kind of strategy, and they were going to raise rates gradually, they were going to do this, that, and the other. They seem to have shredded it all just in the past 2 or 3 weeks. And I would say even just to make it, to bring it down to personalities, I think if you looked at Lane, Philip Lane, who was our central bank governor, he is, I think, very dovish. And if you even look at his still saying things like, we could have a recession, we've got to be careful. He made a speech the day after the German executive member, who's called Schnabel, or Schnabel, no, Schnabel probably. She's to me the new kid in town. She's very hawkish, and I think that she's driving things now. She made a speech saying we need to act very aggressively, and Lane made a speech the day after saying we need to be careful about not raising rates too aggressively. So here's they said, we're not going to give any forward guidance anymore, because the forward guidance is meaningless because we don't believe our own, essentially we don't believe our own forecast. The only thing that matters is spot inflation. So if inflation surprises to the upside, as it done, we have to do something. They said they were going to raise interest rates by a quarter point in July. They did 50 basis points. They said they were going to move things gradually. They did 75 basis points in September. They're now data dependent in each meeting. So like the latest inflation rate. And so you might go back to the original point. If Lagarde says, okay, a lot of inflation is supply driven. It's energy, it's food. What's the point in raising interest rates then? That'll dampen down spending, which is already being dampened down by the high inflation rate. And central banks have this idea about expectations. So we need to make sure that people expect inflation to stay at 2%. But there's a lot of problems with expectations because, for example, a lot of people, if you look at surveys of what people think inflation is, it's always way above. They think it's way above what it actually is. Because most people's idea of inflation, they don't look at the CPI when it's released or the Eurostat, they don't do that. What they do is their own experience. So if you buy things frequently, your expectation of inflation is dictated by the more frequent purchases. So if you go to the supermarket every week and you notice the food prices are going up, that colours your expectation. If you fill your car up every week and it was 1.50 a litre and then it goes to €2 a litre, that colours your expectation. But so if you look at market expectations, you know, there are instruments you can buy, investors can buy, that hedge yourself against inflation in the future. So you can get a market expectation view of what expectations of inflation are. But Schnabel made an extraordinary, I thought it was an extraordinary speech in which she said, if you look at market expectations of Eurozone inflation, it's just above 2% in the medium term. So you might think, well, what's the problem? And Lane has kind of emphasized that. But she said, I've never heard anyone say this before, she said, yeah, but that's just, if we look at consumer surveys, what we really need to concentrate on is economically literate people and what they think. Now, I don't know who these people are, economically literate people. So she is concerned, what she actually said in the speech, she is concerned that although inflation will start to drop, these economically literate people won't believe that the ECB can get it back to 2%. So hence this sudden, I think quite sudden change in ECB thinking, almost like a panic. Almost like we have to be seen to be doing something. I would also say, just to go, if I can go back to that one, if you look at, for example, in the United States, like bond yields, are 3.5, 10-year bond yields are 3.5%. So there is an alternative now for investment. But if you look at what's driven that, you can break down a bond yield into a real component and inflation expectation. And inflation expectations in the States in the last month have actually fallen back down to about 2.3%. So what's driving it is very much the real component, which is basically interest rate expectations. And so in America, it's not so much people have lost faith that inflation's going to go through the roof. It's more concern about what the Fed are going to do. So as I said earlier, you could make a case, a bit more optimistic case about inflation around its peak. This is kind of the dog that didn't really bark, because if you remember about oil prices, the problem always with when oil prices go up, you get like, I think it was Goldman Sachs was saying $200 a barrel, and somebody else was saying $250. So it got up to about 124 in June. This is Brent. So relative to a year ago, that's a big rise. But when I did this yesterday, Brent was about $90, and there's a forward curve you can look at, so it's about $80. So, the thing with inflation is it's the change in, we usually look at the annual change. So if Brent goes up to $90 and stays there, then next year's inflation rate is zero in that component. So particularly then if oil prices fall. So in the last month or so, we've had significant falls in fuel costs. And that's why the Irish CPI fell last month, and why the US CPI has fallen. So, unless that reverses, and of course one of the reasons it's lower is because people are expecting possibly a recession, or certainly weaker growth. So that should help. Irish petrol prices should be a lot lower, I think. I think where I live it's just dropped below 180, but I think they should be below 170, given what's happening in the wholesale prices. But this has obviously been a huge problem and remains a huge problem, which is natural gas. So this is, there's a Dutch, European wholesale price. So a year ago it was only 33 euros. It went up to 350 euros. Currently it's dropped quite a lot actually. And in fairness, European imports of Russian natural gas have fallen quite a lot. And so 1 year forward, it's a bit lower. So if you were to project inflation forward, these things are very significant, because if you do you use the forward market curve, in which case inflation starts to drop? Do you assume it's going to go higher? So these are the ones that could have a very significant impact. But as it stands, you would be a bit more confident that inflation would start to fall. So will we get a recession? And the answer is that, interestingly enough, the only central bank that's expecting a recession is the Bank of England. They've actually formally forecast a recession. Not a huge one, but the market thinks there'll be a recession, but at least until last few weeks, not a very significant one. And I think the weakness in equity markets of late is just that maybe, as I said, markets are now thinking interest rates are going to be a bit higher, so that maybe makes the possible recession maybe a bit steeper. And of course, there's standard market indicators of recession. The obvious one in America is the yield curve. So in America, so 1 year money is up here, and 10-year money is down here. So the usual one is 2 to 10 year, that yield curve. So that's about 45 basis points inverted, which is unusually big. So the market is saying there's going to be a US recession. So here is just these are the growth forecasts. The IMF is tends to lag what the market is saying, but this was their recent growth projections, and you can see quite a big drop down into 2023, albeit they're not forecasting recessions in each of these economies. But I think what we're looking at, in some respects, it's a bit like the pandemic on the fiscal side, because what most governments are doing is they are responding to the hit to households, particularly real income. So the sort of what you might call the IMF playbook is to say, okay, let the market determine the price of oil or gas, but compensate lower income households by transferring money to them. And if you like, as well, do a windfall tax on energy companies to partly fund that. The alternative, which Truss is doing, and France has done, and Spain has done, is to say, well, forget all that. Let's just cap the price of energy, and cap the price of electricity, and the cost of that will be big. It could be huge if electricity keeps going up, or it could be less than people think if gas prices come down sharply. So either way, you've got a very significant fiscal injection into the economy. So during the pandemic, you had fiscal injecting in, monetary policy injecting in. Now you've got the two of them pulling in the opposite direction. Fiscal policy supporting, but monetary policy tightening. And just to, we tend to think of a recession as, well, the market definition is simple. It's 2 consecutive quarters of negative growth. And as it happens, America had 2 consecutive quarters of negative growth in the first half of this year. But nobody thinks America's in recession because its labor market is still very, very strong. So I would say it's the labor market that's the key. And as yet, that's not really cracking in any way. So this National Bureau of Economic Research actually dates business cycles, but they use a whole range of things. But you can see quite, personal income, employment, consumer spending. So interestingly enough, America did have a recession in 2020, and it lasted 2 months on their definition. So, I think if we think of a recession really as how serious will it be, it really has to affect, I think, the labour market for it to be really serious. I've finally just come on to the housing market, and as I said earlier, we had this long period of a long housing expansion. And particularly I think the Irish media tends to look, a very kind of narrow lens at everything in Ireland, as if nothing similar is happening elsewhere. But of course, generally, particularly with property, it tends to be an international cycle. And the same thing that affects us is affecting other countries. So for example, we had low and negative rates. But I also think what doesn't get enough coverage here is the impact of QE. Because if you think of what QE did, because your risk-free rate, if you like, your 10-year bond yield, was low or even negative, think about the Irish one was even negative, if you're an institutional investor, what do? And so a lot of institutions, hedge funds, etc., said, okay, you can get 4 or 5% yield by buying Irish property and renting it out. So let's build apartments and rent them out. And builders were saying, okay, that's great. We'll sell to you off the plans. We guarantee our return. And that's exactly what's happening. So this cycle in Ireland was unusual because previous cycles, there was very little foreign interest in the market. This time there's been a lot of foreign interest via mainly institutional investors. And of course, Ireland is not unique. If you look at, in terms of supply, if you look at the supply of housing in the United Kingdom and the United States, it's grown, but relative to where it was 15, 20, 25 years ago, still much, much lower. So similar problems there. I do think the Irish supply, I think there'll be 25, 26,000 houses or units completed this year. And there's a lot of stuff in the pipeline. Takes a couple of years to come through. So I still think there will be a fair amount of additional supply. Huge fiscal and monetary stimulus, as I said earlier. Oddly enough, the pandemic boosted the housing market, simply because instead of the significant increase in unemployment that you would have got in the past, the government transferred money to people to keep their incomes up. And of course, in the supply side of the economy, in the professional services and so on, people just kept on working. So there wasn't that hit to demand that you would have seen in the past. So now, of course, we're in a different cycle. So higher bond yields, higher short-term interest rates. Already in the US, it's particularly noticeable that new housing, new home sales, not so much on prices, but new home sales, just existing home sales, housing starts, they've all turned over quite noticeably. So interest rates tend to affect the housing market, predominantly. So you would expect things to slow down. So I think the interesting thing is, though, will you get big price falls? And confidence is a big thing in housing. If people expect house prices to fall, they'll wait, and that impacts demand and so forth. If they expect house prices to rise, it's reversed. They bring forward their decisions. So you can be a bit reinforcing, but I think for big house price falls, you need, one, to have had massive credit growth driving it, and as I'll show in a minute, in Ireland, that certainly hasn't been the case. Or B, you have the banking sector is severely damaged, which isn't the case either right now. So just looking at the Irish economy in a bit more detail. So here's the residential house prices. You can see year over year. I've put Dublin and the rest of the country on, and you can see Dublin has actually lagged the rest of the country generally speaking. Huge increases actually in the border counties over the last year or so, which has been up 20% year over year. Southeast also very strong, 15-16%. But you can see clearly that things turning over. But what's happening right now? So in the last 3 months, house prices went up 2.7%. So you might think that's still quite a lot. So that's an annualized figure of like over 10%. But because it went up more than that a year ago, maybe 3% or 3.2% in the 3 months, the year-over-year numbers have started to fall. And I think that's what's going to happen. So you'll get that coming down. I'm not sure, I don't think it'll go negative particularly, unless, as I said, we get, there's a big, huge expectation element that comes into it. But it doesn't seem to be there, the conditions don't seem to be there, particularly on the banking side for that to happen. The way I tend to look at housing very much as employment driven in terms of demand. People talk about the population dynamics, which is fine, but there's a lot of people in certain countries where there's no house price inflation because they need the income to buy the houses. And what drives income is wage growth and employment growth. So in Ireland's case, of course, they've been very strong, and as a consequence, you get a massive increase in the demand for housing. So whether that comes into higher rents or higher prices partly depends on credit growth. And of course, in our case, credit growth, leverage, if you want to call it, particularly, is now limited by the central bank. So consequently, you'll get more demand being pushed into rents. So as I said, they're up about 11% in the second quarter. Interesting as well, I think, particularly in Dublin, it's very sensitive to the multinationals and particularly ICT, your Googles, LinkedIn's, I was going to say Facebook, Meta, whatever now it's called. I think they've been a huge driver of rents in Dublin. And when they closed, during the pandemic, I think a lot of people in those companies were told to work from home. But in their case, the home was maybe Spain or Portugal or whatever. So I think that did have an effect on rents in Dublin particularly. And now that's changed significantly. I think the other problem, of course, is just the politics of it, because clearly housing is a huge political issue, and the populist response always is to do something to boost demand, not supply. So, you get Help to Buy for first-time buyers, and now this new First Home scheme. So the government is actually buying a bit of the house for you. So that pushes up demand. But on the rental side, you've got rent controls, and as daft.ie shows, there's an inevitable response in that the number of people who want to rent out properties has fallen quite significantly. So, as I said earlier, if you look at the employment situation in Ireland, this is our GDP figures, which have obviously been pretty stellar. So the Irish economy this year, nominal GDP could hit 500 billion, I think. Obviously, exports are the key driver. So the type of exports we have seem to be kind of immune to the cycle to some degree. Of course, there's a huge recession. It might be different, but chemicals, pharma, they seem to. If you look at everyone's forecasts on the Irish economy, central bank, the private sector, everyone underestimates growth every year. And the reason that is they underestimate exports all the time. And here's the employment growth. So, you see a bit of a hit in pandemic, but then recovery and record highs. However, there is a there is a hit, of course, and that is due to inflation. So here, the grey bars are household, nominal household income, disposable income growth. So you can see each year income growth has been pretty good, 4 or 5%, and some years big transfers from the government went up to 6.5%. And in that period, of course, virtually no inflation. So we've never, somebody else once said, we've never had it so good in that sense. We have full employment, very low inflation, very strong nominal real income growth. So naturally enough, in that environment, you would get a very strong housing market. So what's happening now, of course, is something that hasn't happened for a long, long time. And that is nominal income growth is maybe running at 4.5%, 5%. But as we'll see, inflation is probably going to average this year over 7%. So big hit to real incomes, less of a hit next year. I think that will obviously impact parts of the economy. Retail sales in July were down 8% in real terms on the previous year. And interestingly enough, the nominal value of retail sales was actually slightly negative, like minus 0.5%. So the difference is obviously price rises. But because nominal retail sales are now actually falling, I think you're beginning to see some price discounting coming in, particularly in supermarkets. So it's another reason why maybe inflation would have peaked. So generally speaking, to finish, generally speaking, higher interest rates hit the housing market. This time around, and it will this time, but this time around, I think for Ireland, there's two big differences. The first is captured in this chart. So this is a chart which this is data which the central bank publishes periodically each quarter, and it tells you how much loans each house in aggregate households have, and how much what's their assets, the financial assets, and their wealth. So wealth in Ireland is largely housing wealth. But what I've done on this chart is this line here is the amount of debt that Irish households have, and you can see that basically for the last 14 years, and you can see it's probably coming to was coming to an end. Households have been deleveraging. I don't think if it would have gone back there, anyone would have said that would have taken all that time. I would still have continued that households would be reducing their debt, which has massive implications, did have massive, and does have massive implications for banks, of course. And secondly, this is their liquid assets. So in this case, it's deposits in banks and cash. And you can see that period there, 2017, they crossed over. And currently, liquid assets, household liquid assets, cash and deposit, exceeds loans by 56 billion. We have become Germanic. We were maybe Italian. We've now become Germanic in the sense of we save a lot. Now, obviously, that's an average figure. An awful lot of households don't have any savings, but other households have a lot of savings. And so the aggregate figure, you can see quite clearly. And in the latest figure our savings ratio in the first and second quarter of this year was 19%. In other words, households are spending, on average, in aggregate, 80% of their disposable income. So normally we would be spending maybe 90% if you go back 3 or 4 years. So we're saving a huge amount of money, and also the corollary of that is that banks have a huge amount of deposits. So the loan to deposit ratio in Irish banks is about 70%. Back in 2007, it was about 170%, i.e. banks were borrowing money from abroad in the financial markets to fund credit growth. Now we have the opposite situation. Huge amount of excess deposits in the banks. What does that mean? It means that those deposits have a cost of basically zero. So interestingly enough, the central bank publishes new data every month for retail rates in Ireland. The ECB publishes it. And since the start of the year, the average new mortgage in Ireland is actually 5 basis points lower. It's actually 263 in July, and in December it was 268 or 269. The average ECB across the Eurozone has gone from 130 to 208. So it seems quite clear that the huge liquid deposits are allowing banks, for the time being, to absorb the increase in market rates. Now, I'm sure some of you will be aware, there's 3 lenders in the market that are particularly strong who are non-banks, non-Irish banks. So that's Avant, Finance Ireland, and ICS or Dilosk. So they're funding in the market. So they're more problematical. You know, their cost of their funds has risen because they don't have that deposit base. German rates, actually. German rates have gone from like 150 to 280. German rates, new mortgages from Germany are higher than Ireland now. And then the other thing is just, again, there's been a massive change in the interest rate, mortgage interest rate market. For a number of years now, new mortgages have been over 80% of them. In fact, it's over 90% for first-time buyers are at a fixed rate. So consequently, if you think about that, then new mortgages adding to the stock are at a fixed rate, and a lot of the stuff that's rolling off was borrowed 20, 25 years ago, when over 90% of new loans were variable. So you can see here, this is the total existing stock of mortgages. So over time, that has a big impact. So here's 90-odd% is variable, and it's just dropped below 50%. Of course, if you have a variable rate, a tracker rate, so about half the mortgages were tracker go back 7 or 8 years ago, and that's now down to below 30%. So that does suggest that, of course, Irish interest rates will go up, but maybe not as rapidly, certainly haven't gone up as rapidly as they have elsewhere. And I think those are some of the reasons why maybe the mortgage impact will not be as dramatic as it would have been certainly 15 years ago. So to sum up, I think a key factor is that economies are still around full employment. Now that can change, obviously, and the recession, how deep it will be will depend on that, but I think it's important that will be a key factor, I think, in what happens. Central banks initially took the thing, it was all supply driven. I think they've kind of panicked a bit, and particularly the ECB. I think it's impossible to say what the ECB is going to do now. And they also have the huge problem of, in a way politically, how to placate both Germany and Italy, if you like. So Germanic view, inflation is too high, and it's higher in Germany than here. We need to do something. But the more aggressively they raise rates, the more difficult it becomes for Italy, a high debt economy. So I think the market was pricing for a kind of Goldilocks recession, or not even that in America maybe. I think that's changed a bit, and I think that explains a bit why the bit of a lurch down in the last month or two. last month. Fiscal monetary policies are going opposite directions. The ECB hawks are now in charge. I do think that there is an argument perhaps that inflation is around its peak, maybe not in certain European countries because of the lagged effect of the gas on the gas market, the way it impacts electricity, but certainly maybe in America, with falling oil prices that helps. We'll see a big fall in real, or are seeing a fall in real incomes, but as yet employment not affected. And clearly there'll be a slowdown in the housing market, but I think there's a number of factors which suggest it probably won't be as significant as it would have been in the past. Okay, I'll stop there. Thank you.
Thanks, Dan. I feel ready to sit an economics exam after that. I certainly learned a lot, and we'd be delighted to take any questions from the floor if anybody has any. And just in case people are shy, I'll think of one. Could you flick back to the housing graph? I think it was slide 14, please.
Which one was that?
It was just the price of, it was the inflation of house prices over the last number of years.
Oh, sorry, yeah. There?
There, yeah. I was just wondering, and I don't mean to put you on the spot when you're our speaker, that would be unfortunate, but the period there, May, September, January 1920, there was a very flat period for house prices, and I just wondered if you had any theories as to what caused that hiatus in price growth, and then what caused it to kick on again.
Brexit?
Mm-hmm.
I think there's, as I mentioned earlier, there's quite a pronounced expectational element sometimes in markets, particularly in the housing market, both from you're a potential buyer and a bank as a potential lender. So I think around that period with Brexit uncertainty, that banks became a bit more cautious because there was a lot of stuff. Obviously, if you think back, it's almost as if who cares about Brexit now? But at the time, it was
when our troubles were small.
Yeah, it seemed like a huge thing, and it was going to affect. You remember all these stuff? Oh, it's going to reduce Ireland's GDP over the next 10 years by X amount, all that kind of stuff. So I do think that had an effect on the market, both in terms of, you can see it in mortgage approvals quite clearly. So people became a bit more cautious, and also banks became a bit more cautious, which is what you're seeing now. Mortgage approvals have slowed, and banks have tightened credit. There's a quarterly thing that the ECB does, which is credit standards for all the banks across the Eurozone. And you can see it, not dramatically, but there's a tightening of standards. So I think that uncertainty is hard to, you can't really model it or anything, but I think it affects things. And it's probably affecting things now.
In the event he was to pull out suddenly, Putin, and say, oops, sorry, on mature reflection, bad move, and those main drivers of inflation suddenly collapse.
Yep.
And the inflation worry, the inflation concerns goes away suddenly.
Yep.
What happens, sir? What?
Oh well, I think if you say what's driving central banks, the point really making is particularly ECB. I think all of them is spot inflation. So if you got, I think the other problem for them is if you go back over the last 7-8 months, every month inflation has tended to surprise to the upside. So if you got a few months where it surprised to the downside, I do think that will change things quite a lot in terms of where, the markets talk about the terminal rate, this tightening cycle, where will it end? and we don't know obviously, but the market is at any moment in time priced. So I think spot inflation is a key driver right now, and if you did get some positive surprises, then I think, in terms of lower inflation, I think it would affect interest rates quite a lot. Yes, sorry.
So could you go back to your inflation expectation projected by the central bank right now, since it's been obviously over the next, exactly that, right? And so I'm looking at the forecast, then I'm looking at what the market's pricing in for policy rates. We're still talking about negative real interest rate.
Yeah.
Right, so we're not that
well,
not
so much here though.
Well, yeah, through 2023, right?
Yeah,
That's where the market is trying to decide whether the central banks will stop, right, and stop pricing in cuts, or they will continue to hold the rates.
Yeah.
So through next year, there's actually argues that they will,
real rates are still low, negative in fact. Yeah, sure, but then you go back to the argument about if I change rates today, it's going to affect inflation here, not here. So you're trying to, so at least conceptually, you are looking 18 months, 2 years out in terms of why you are putting rates. So if ECB rates settled at, for the sake of argument, 3%, that would be a real rate in 2 years' time, if this was correct, of what, plus 1%. So that's how they would look at it. They would talk about normalizing rates. You're right, of course, in the short term, you know, if your ECB rate is 1% and inflation is 7%, then you've got massive negative real rates. But you can't affect inflation now. That's the problem with monetary policy. You can only affect it in the future. But I'm saying once you lose, if you lose faith that is going to happen, which I think they have, then you start to think, okay, maybe inflation in 2 years' time isn't going to be 2%, it's going to be 4%. In which case, you're then looking at a much higher terminal rate. Or the alternative is, of course, that we don't go back to that, but we settle at an inflation 3%. That instead of 1.5% in the Eurozone, we have inflation of 3%. So that needn't be a significant problem if the central bank essentially de facto accepts that. I don't mean they'll formally announce that, but that's, I think, a possibility, not just in the Eurozone, but across the main economies, that we end up with inflation a bit higher than it was, which needn't be a problem. The other thing just I didn't mention, of course, is that central banks always talk about second-round effects, by which they mean what matters. You can't stop oil prices or natural gas going up, but what you can influence is wage expectations and wage. So, but right now in the Eurozone, again, if you look at Philip Lane's stuff, he's emphasizing this all the time. Wage inflation hasn't taken off, at least this year. So that suggests that the second round effects aren't coming through at all. Sorry?
The chart you had earlier on showed inflation, I think, at the ECB and in Ireland and in the UK and in the US all looking fairly similar, following a similar pattern. Yeah. I remember in the noughties, the Irish inflation rate really diverged a lot from European rate, and European rates, interest rates, couldn't seem to control what weren't appropriate for Ireland when it was in its very, very high growth period leading into 2008. And it seems that now Ireland is in a very high growth phase and has been for a few years. So is there a risk that Irish inflation is going to diverge from European inflation and that we're going to sit with really high inflation here?
Yeah. Well, there's certainly a risk, but I think there's a big difference. A big difference is that we're very open, so a lot of our inflation is imported, But particularly what matters for our inflation is the euro sterling rate, because a huge amount of what, particularly on the consumer side, comes in from the UK. So the fact that the euro has not fallen particularly against sterling in the past year, I think helps us in that respect. So the fact that you know, it's if you look at coverage of a country's exchange rate, if say, for example, you look at the UK, they've put a huge amount of emphasis recently on the fact that the dollar is at a, I think it's, what is it, probably the mid-80s, it was as low against the sterling against the dollar. But the euro is also extremely low against the dollar. I mean, we're below parity. So I think from our Irish inflation perspective, that's a key factor. Euro sterling matters a lot for our inflation.
Dan, so one observation, one question. So the observation is Palomines involved in food manufacturing. So his price increase to the retailer 3 months ago was 20%. The retailer said it'll take them 8 weeks to get through their system. He said, while you're there, here's another one for another 10% in 8 weeks' time.
Right.
And he says his business is under considerable pressure trying to pass on that inflationary price increases coming through to his business from suppliers, just the price of everything going up. Second question is, we've had the worst bond market in 50 years from an investor perspective. When does that change?
Well, you might say it's the best opportunity in 50 years to buy bonds, isn't it? No, I think to go back to, I think it's easier to decompose the thing in America, and it's largely driven by that interest rate expectation. So you're at like 10-year yields, 3.5%. You know, I was kind of half joking earlier, but you remember the idea for a long time in markets was TINA. There is no alternative. You know, if bond yields are negative, you know, equity is the only game in town. There is a bit of an alternative now with 10-year yields at those kind of levels. But if inflation is peaking, the market will change its view on the Fed, in which case 3.5% might be a very attractive level. I'm not saying necessarily that's the peak, but for it to go to 4.5%, you would really need inflation that to start to go over here again. You know, but why does inflation fall? Why doesn't inflation go on forever? And the answer is basically a couple of things. One is base effects. So back to the point, if oil prices double in a year, unless they double again the following year, energy inflation will drop. And the other point is that, to your observation, that as real incomes get hit by inflation, people cut their spending on discretionary items. I mean, for example, if you go into a supermarket, one of the not as discretionary as it should be in Ireland, but drink, wine. Beginning to see quite noticeable discounts on that. So it's discretionary spending that people have cut back on. So although there's a cost, although costs have gone up for the retailer, he can't pass them all on eventually. So it's negative for his profit margin, but that's how eventually inflation starts to slow down.
Now we have a question over here. Waiting patiently.
There's several things that come into my mind, but just when you're talking there, it sounds like we should have the Dan McLaughlin index on the wine prices, you know. You know, so we have the McDonald's world index, but it just all the trends go the same way. But the U.S. economy, in terms of the shocks we've gone through, they're a net exporter of energy. Obviously, a big arms supplier. So you think those two things, you know, the longer this goes on, in some ways, the American economy won't suffer the same way. You know, maybe we'll get these things under control. So it's hard to say, you know, that they're geared towards a win-win in a war, you know, that we, you know, let's not go there, but I mean, you can see there could be winners out of that. Whereas the European situation, a huge energy deficit, probably the only thing where we're probably okay is probably food security. You know, I mean, I think we all know about the rising costs, but I mean, Europe has generally been a stable enough in terms of its own food supply. So the idea that these economies are going the same direction, and indeed the UK as well, just seems wrong. You know, if you take a sort of a 3-5 year
No,
view.
yeah, certainly on your point about energy, you're perfectly correct. You know, but that would, you know, that's really you're encapsulating the argument for the dollar, and you know the dollar has. If you have assets in dollar-denominated assets, you've done a lot better, obviously, than euro-denominated assets. So, so the interesting thing is, though, is that all priced into the market? I mean, the euro is around parity. Maybe not, you know, because go back to the point as well that because the Fed's dual mandate, if the economy does start to slow, more noticeably, and unemployment starts to rise, and you do get some falling inflation, in market parlance, they will pivot much quicker than the ECB. Now, I would be more concerned, I think, you know, about Europe. You're perfectly right about the energy situation, but you know, even if you just think what's happened in the last week, what I sound like I'm going to be a Brexit fan here, but what I find puzzling is the European Commission. They overpromise all the time and underdeliver. So they talked about, for example, a windfall tax. And some of the new headlines said Brussels is going to put... Brussels doesn't do anything. What they're actually proposing is that each country takes excess profits, and they're calling it a tax, because if you call it a tax, you have to have unanimity amongst the EU members to put it through. So they're proposing that each country takes money off energy producers and distributes it, right? And they sell that as if it's a huge thing. But in our case, for example, because we get so little of our energy from non-gas electricity, the amount of money that would be raised would be very, very low anyway. So, you know, I would be, it's just very dependent on, to go back to this man's point about Putin.
We're not going to stop you, just wanted to check, look at the room with you. Sorry, Dan.
There's a big hook, I think.
Yeah, it's not a hook, no.
So no, I'm not. I think you've got a very good point, and I think that's really the concern about Europe, and I think even the broader concerns that I mentioned about Italy and you know what will happen about what they can do. I mean, you can't tighten monetary policy and then start buying loads of bonds at the same time. That just so yeah. So it is an argument still, perhaps, for being dollar, you know, be more dollar weighted.